Someone tried to withdraw their own money last week. Not a suspicious amount, not from some obscure foreign account, their own money from a fund they'd invested in for years. The institution said no, not permanently, just temporarily, due to market conditions. Redemption requests exceeded expectations. Please try again in 90 days. 90 days. Their money, frozen. This person isn't alone. I've received dozens of similar messages recently. People attempting to access funds they assumed were liquid, being told to wait, being told circumstances have changed, being told their ownership doesn't mean immediate access. Something is shifting beneath the surface of the financial system. The ground that felt solid is revealing cracks. The rules that seemed permanent are being quietly rewritten, and most people are so focused on daily survival that they're missing warning signs that demand attention. Today, I'm going to show you what's actually happening to money in this economy, why your financial life feels stuck despite doing everything you were taught to do, what the institutions aren't telling you about access to your own assets, and what this means for anyone trying to build stability in an increasingly unstable system. This isn't conspiracy. This is observation of patterns that are visible if you know where to look. The dots connect into a picture that explains why life isn't getting better for most people, despite headlines suggesting recovery and growth. The picture isn't comfortable, but understanding it is essential for anyone who wants to protect themselves from what's developing. Let me show you what I see. The warning signs started appearing in energy markets before most people noticed anything was wrong. Oil prices spiked with a speed that caught even experienced traders off guard. The movement wasn't gradual, it was violent, the kind of price action that signals something beyond normal supply and demand fluctuation. Energy markets act as early warning systems for the broader economy. Oil touches everything: transportation costs, manufacturing inputs, heating and cooling, food production and distribution. When energy prices surge, the costs cascade through every sector with mathematical certainty. The spike we witnessed signals instability that extends beyond energy itself. The prices reflect fear about supply disruption, concern about geopolitical developments, anticipation that conditions will deteriorate further before they improve. Rising fuel costs ripple across the entire economy within weeks. The trucking company pays more for diesel, the grocery store pays more for delivery, the consumer pays more for food. Each link in the chain absorbs what it can and passes the rest forward. The inflation you experience at the checkout counter often began as an energy price movement months earlier. By the time you notice, the cause has already been obscured by layers of price adjustments throughout the supply chain. This energy shock isn't occurring in isolation. It's occurring alongside shifts in government priorities that explain where money's actually flowing in this economy. Government focus has shifted heavily toward defense manufacturing in ways that affect everything else. The expansion of weapons production is happening at scale that most people don't appreciate. Factories are being built or converted, production lines are being established, orders are being placed in quantities that represent years of committed output. Military spending is taking priority over domestic needs in ways that become visible when you examine budget allocations rather than political speeches. The money going somewhere is always money not going somewhere else. The resources directed toward defense are resources not directed toward the things you interact with daily. Roads deteriorate, schools struggle, healthcare access diminishes, not because money doesn't exist, but because money has been directed elsewhere based on priorities that don't center on your quality of life. The narrative framing this spending emphasizes necessity. Conflict demands response. Security requires investment. The threats are real and the responses are appropriate. I'm not debating the necessity. I'm pointing out where money flows and where it doesn't. The direction of that flow explains why your life doesn't feel like it's improving, despite the economy supposedly growing. Growth is occurring, just not in places that benefit you. The wealth being generated is flowing to corporations positioned to capture it, not to ordinary citizens. Major defense contractors are experiencing revenue growth that creates extraordinary returns for investors positioned in those companies. The conflict that creates suffering for many creates profit for some. This isn't unique to defense. It's the pattern across the economy. Large institutions positioned to benefit from policy decisions and economic shifts capture value that disperses minimally to the broader population. The perception that elites and large companies gain from chaos while ordinary people struggle isn't paranoid fantasy. It's observable in earnings reports and stock prices. The companies benefiting most are the companies most connected to the flows of government spending and crisis response. Ordinary people are seeing little improvement in their financial situations despite working as hard as they always have. Wages increase slower than costs. Savings erode through inflation. The gap between what you earn and what stability requires continues widening. This growing gap between public needs and where money is allocated creates the frustration you feel but might not be able to articulate. Something is wrong. The system isn't working. But the something and the system remain vague because the actual mechanics are obscured by complexity and messaging. The mechanics involve choices about priority, and the choices being made don't prioritize you. The neglect of domestic infrastructure and services has reached levels that affect daily life for millions. Public transportation systems deteriorate. Roads need repair that doesn't come. Schools lack resources for basic functions. Healthcare becomes harder to access and more expensive when accessed. The contrast is jarring when examined directly. Funds are available for military expansion. Funds are unavailable for the systems ordinary people depend on. The availability isn't about total resources, it's about allocation choices. Frustration over these misaligned priorities builds without finding productive outlet. People sense unfairness but lack framework for understanding how the unfairness operates. They feel stuck but don't see the mechanisms creating the stuckness. The mechanism is straightforward. Money is going somewhere other than where it would improve your life. Understanding this doesn't immediately change it. But understanding prevents the confusion that makes people blame themselves for systemic failures. You're not failing to improve your life because you're doing something wrong. You're struggling to improve because the system isn't designed to help you improve. It's designed to direct resources according to priorities that aren't yours. What concerns me more than current allocation is emerging signs that access to existing assets may not be guaranteed. The liquidity restrictions I mentioned at the start aren't isolated incidents. They're appearing across various financial products with increasing frequency. Investors attempting to pull funds from certain investment vehicles are being told withdrawal isn't currently possible. Large institutions are limiting how much money can be withdrawn and when. The money is technically yours but practically unavailable. Private credit markets are showing early signs of stress that aren't yet visible in headline indices. The instruments that promised returns slightly better than traditional options are revealing that the better returns came with conditions that are now activating. The fear that access to money may not be guaranteed when needed isn't irrational. It's based on observable events. People who assumed they could access their funds are discovering that assumption was incorrect. This pattern of capital being locked or delayed extends beyond single fund categories. Multiple cases exist where individuals and companies struggle to retrieve funds they own. The money hasn't disappeared. It's held by institutions that aren't releasing it according to expected timelines or terms. Financial systems are slowing or restricting payouts in ways that receive minimal media attention. The restrictions don't make headlines because each individual case seems small. The pattern across cases reveals something larger. The theme emerging is reduced financial freedom despite nominal ownership. You own the asset, you can see it on your statement, you cannot convert it to cash when you need cash. Ownership has become partial in ways the original terms may not have clearly communicated. Some of this relates to government actions creating uncertainty that freezes normal function. Businesses are struggling to recover money tied to policy decisions, import duties paid, deposits held, funds transferred through channels that government action has subsequently affected. Confusion exists around how or if these funds will be returned. The processes for recovery are unclear, the timelines are undefined, the amounts are significant for the businesses involved. Legal battles between companies and authorities are increasing as organizations attempt to recover what they believe is owed. The courts provide eventual resolution, but eventual doesn't help with immediate cash flow needs. The lack of clarity undermines trust in institutions that function depends on. Commerce requires predictability. When government actions create unpredictability about basic matters like whether money paid will be returned, commerce slows as participants become cautious. Government power is being exercised in ways that raise questions about process and accountability. Leadership is potentially bypassing traditional processes for significant decisions. Executive authority is being used for actions that might traditionally require legislative approval. The speed of action comes at the cost of the deliberation that checks typically provide. I'm not making political judgment about whether these actions are right or wrong. I'm observing that actions taken quickly through executive authority create different uncertainty than actions taken deliberately through legislative process. Questions around accountability and rule of law affect investor confidence regardless of the specific policies involved. Capital needs predictability. When the rules might change suddenly based on executive decision, capital becomes cautious. That caution affects economic activity. Public money is being used to backstop risky situations in ways that socialize costs while privatizing profits. Government is stepping in to support high-risk sectors affected by geopolitical conflict. Energy and shipping particularly are receiving support that protects companies from losses they might otherwise bear. Taxpayer exposure to costs tied to conflict grows through these interventions. If the interventions succeed, the supported industries return to profitability that benefits shareholders. If the interventions fail, taxpayers absorb losses. This pattern repeats across crises. Private entities take risks. When risks go badly, public resources absorb the losses. When risks go well, private entities capture the gains. The arrangement persists because it benefits those with political influence while diffusing costs across populations too dispersed to organize effective resistance. You pay through taxes and inflation. The beneficiaries of backstops pay through political contributions and lobbying that maintain the arrangement. Signs of economic slowdown are appearing in sectors that drove recent growth. Big tech companies are cancelling or scaling back major projects that were announced with confidence months ago. The data centers, the expansions, the hiring plans, revisions are occurring that suggest confidence has weakened. Rising debt pressures are affecting large companies that borrowed heavily during the low-rate years. The debt that seemed manageable when rates were near zero becomes burdensome as rates remain elevated. Layoffs and reduced expansion plans indicate that corporate management sees conditions differently than they did recently. The actions companies take reveal their actual expectations more reliably than the statements they make publicly. The shift from growth optimism to caution is palpable if you watch corporate behavior rather than corporate messaging. Hiring freezes, budget cuts, project cancellations. These actions speak louder than earnings calls suggesting everything is fine. Capital is rotating toward assets perceived as safer in uncertain conditions. Investors are moving money into inflation-resistant instruments, gold, certain commodities, assets with historical patterns of holding value during turbulence. Defensive positioning due to uncertainty is visible in market flows for those who track where money moves, rather than where commentary suggests it should move. The shift away from high-risk investments hasn't appeared in headline indices primarily because index concentration makes a few large companies disproportionately important. The broader market beneath those giants is behaving differently than the indices suggest. Smart money is moving toward protection while retail investors watch indices that obscure what's actually happening. The divergence between what sophisticated investors do and what headlines suggest creates opportunity for some and trap for others. What disturbs me beyond financial mechanics is how serious events are being presented. Wars being framed in ways that feel more like entertainment than the profound tragedy it represents. The messaging blends conflict with entertainment-style visuals and commentary. Serious geopolitical events are presented with production values designed to capture attention rather than convey gravity. This treatment creates desensitization to real-world consequences. The suffering becomes abstracted. The deaths become statistics. The implications become content rather than cause for reflection. I raise this not to moralize, but because the desensitization has financial implications. Public support for costly interventions becomes easier to maintain when the costs are presented as spectacle rather than sacrifice. The money flowing toward conflict continues flowing because the conflict doesn't feel real to populations experiencing it through screens. The framing affects the allocation decisions I described earlier. Entertainment doesn't demand the same scrutiny that tragedy would. Resources direct toward the entertaining conflict without the resistance that resources directing toward obvious suffering would encounter. Global tensions are escalating in ways that increase risk across multiple dimensions. Multiple powerful nations are involved directly or indirectly in current conflicts. The involvement includes intelligence sharing and strategic support between rivals. The lines of alignment don't match simple assumptions about who supports whom. The heightened risk of broader conflict isn't hypothetical. The involvement of major powers creates tripwires that could transform regional conflict into something larger. Financial markets price these risks imperfectly because the risks involve scenarios that haven't occurred in decades. The models don't know how to weight possibilities that would be unprecedented in the experience of current participants. The risk premium that should attach to potential global conflict remains artificially low because participants can't process scenarios outside their experience. This mispricing creates both danger and opportunity depending on your positioning. Meanwhile, citizens are experiencing government failure in personal terms that feed broader institutional distrust. People abroad during crisis periods are struggling to return home. The assistance systems that should help, the hotlines and evacuation plans, prove inadequate when actually needed. Stories circulate of citizens stranded without government support they expected to receive. The frustration and sense of abandonment these experiences create extends beyond the individuals involved. When systems fail, people in moments of genuine need, trust erodes that doesn't rebuild easily. The person who couldn't get through the hotline tells others. The story spreads. Confidence diminishes. This erosion of trust in institutions has reached levels that affect behaviour across the economy. Doubts about financial systems, government, and leadership now pervade conversation in ways they didn't a decade ago. The feeling that systems don't work when people need them, most has moved from fringe concern to mainstream sentiment. Skepticism toward official narratives has grown as discrepancies between messaging and observable reality accumulate. People notice when what they're told doesn't match what they experience. Enough accumulated discrepancy produces the pervasive distrust now evident. This distrust affects financial behaviour, savings rates, investment choices, willingness to participate in systems perceived as unreliable. The economic effects of institutional distrust compound as distrust spreads. Understanding why people freeze money and restrict access requires understanding the risk that built during years of unusual conditions. Markets became complacent after years without major downturns. The participants making decisions today largely haven't experienced genuine crisis conditions. Their models and intuitions developed during extended stability. Easy access to cheap money encouraged investments that don't withstand normal stress. Projects funded at near zero rates don't work at current rates. Companies financed assuming cheap capital forever face pressure as the assumption proves wrong. Hidden risks accumulated beneath the surface during the years of accommodation. The risks weren't visible because conditions didn't test them. The testing is beginning. What seemed solid is revealing fragility. The expectation among those who study financial history is that the longer stability lasts artificially, the harsher the eventual correction. The stability we experience was artificial, maintained through policy intervention that papered over problems rather than resolving them. The correction those interventions postponed hasn't been cancelled. It's been delayed and likely amplified. Fear of incoming major reset isn't fringe perspective. It's the position of serious analysts examining conditions without career incentives to maintain optimism. Comparisons to past financial crises appear in research from institutions with no interest in fear-mongering. The conditions that preceded previous crises are present or developing. The suggestion that a large downturn is overdue reflects historical pattern, recognition, not pessimistic bias. Concern that asset values are inflated and untested grows among those who examine valuation metrics rather than price momentum. The testing that would reveal which assets have genuine value hasn't occurred because conditions haven't demanded it. The idea that forced selling will happen suddenly and violently reflects how crises actually unfold. Not gradually with time for adjustment, suddenly with acceleration that overwhelms normal responses. The freezing of redemptions I described at the start represents institutions recognizing that forced selling is possible and preparing for it by restricting what they can restrict, which is your access to your own money. This brings us to the core reality that connects everything I've described. The system prioritizes power, profit, and conflict over everyday people. This isn't accusation, it's description of how resources actually flow and don't flow. Financial pressure on individuals continues while large systems expand. Your struggle to improve your situation isn't personal failure. It's the predictable outcome of a system designed to extract value from you rather than create it for you. People feel stuck while massive money flows happen elsewhere. The flows are visible if you look at defense budgets, corporate earnings, and institutional accumulation. The stuck feeling is accurate perception of where you sit relative to those flows. You're not in the flow. You're downstream from it, receiving what the upstream participants allow to reach you after they've taken their share. Understanding this doesn't immediately change it, but understanding prevents the self-blame that adds psychological suffering to financial difficulty. Understanding enables strategic response rather than confused reaction. The strategic response begins with recognizing that your well-being is not the system's priority. This recognition isn't cynicism. It's accurate assessment that should inform how you engage with institutions and make decisions. Institutions will freeze your money when doing so serves their interests. The terms allowing this are buried in agreements you signed without reading because nobody reads them. When conditions stress the institutions, your access becomes negotiable, despite what you assumed. Protecting yourself requires recognizing this possibility in advance, rather than discovering it during crisis. Liquidity deserves more attention than most people give it. Having assets you can actually access when needed matters more than optimizing returns that you might not be able to realize when you need to. Cash reserves that seemed excessive during stable conditions seem prudent when redemptions are being frozen. The opportunity cost of holding cash becomes insurance premium against illiquidity that could otherwise devastate. Diversification should include attention to access, not just asset class. Different institutions have different stability. Different structures have different liquidity characteristics. Concentrating assets where a single institution's decision could freeze everything creates risk that diversification across asset classes alone doesn't address. Physical assets that don't depend on institutional access provide backstop that purely financial assets cannot. Real estate, precious metals held directly rather than through funds, assets that exist in the physical world rather than as entries in institutional ledgers. I'm not suggesting abandoning financial assets. I'm suggesting recognizing that financial assets depend on institutional function, and institutional function is showing strain. The domestic infrastructure neglect I described will affect your life directly, regardless of your investment positioning. Roads that deteriorate increase your transportation costs. Schools that decline affect your children's futures. Healthcare that becomes less accessible affects your family's well-being. These effects aren't primarily addressable through investment strategy. They're addressed through geographic choices, community building, and reducing dependence on public systems that aren't being maintained. People with resources are increasingly creating private alternatives to public systems that no longer serve them. Private schools, concierge healthcare, gated communities with private security and maintenance. The retreat from public systems accelerates as those systems decline, creating feedback loops that further accelerate decline. Your ability to create private alternatives depends on resources. Building those resources, despite system headwinds, requires understanding what you're working against, rather than assuming the system supports your success. The skills and capabilities that create personal value become more important as institutional support diminishes. What you can do matters more when what institutions will do for you becomes unreliable. Human capital that produces value regardless of institutional function provides security that financial capital held within institutions may not. Health that reduces dependence on struggling healthcare systems provides practical value beyond what medical spending could provide. The investment in maintaining your physical capability pays dividends throughout the uncertainty ahead. Relationships that provide mutual support outside institutional frameworks become valuable as institutional support withdraws. Community that would help you if systems failed provides insurance that no financial product offers. These suggestions might seem disconnected from financial advice. They're not. They're recognition that financial security extends beyond portfolio construction into realms that traditional financial planning ignores. The uncertainty surrounding government actions and institutional behavior will continue. Clarity isn't coming soon. The confusion around policy direction, around what rules apply, around how institutions will behave reflects genuine uncertainty at decision-making levels, not strategic ambiguity that will resolve according to plan. Navigating uncertainty requires accepting uncertainty, rather than waiting for clarity that isn't arriving. Decisions must be made despite incomplete information. Positioning must occur despite unknown developments. The paralysis that uncertainty creates in many people becomes strategic disadvantage. While they wait for clarity, conditions develop, opportunities pass, risks materialize. Acting despite uncertainty means accepting that some decisions will prove suboptimal given how events unfold. The alternative of not acting creates different suboptimality. Neither choice offers escape from uncertainty's costs, but acting creates possibility of capturing upside while managing downside. Waiting guarantees absorption of whatever happens without having position to benefit from favourable developments or protect against unfavourable ones. Let me tell you what I'm actually doing in response to what I've described. I've increased cash reserves beyond what conventional advice suggests. The opportunity cost of holding more cash is real. The insurance value of accessibility justifies the cost given current conditions. I've diversified across institutions to avoid dependence on any single entity's decisions. The money frozen at one institution doesn't affect money held elsewhere. The friction of multiple accounts seems worthwhile given redemption restrictions appearing. I've added physical assets that exist outside institutional systems, not as majority position. As insurance against scenarios where institutional access fails more broadly than the isolated cases currently visible. I've reduced exposure to positions that depend on continued institutional normalcy. The investments that work only if everything continues functioning smoothly face risk if function degrades. I've invested in capabilities that produce value regardless of institutional support. Skills that create income, health that reduces dependence, relationships that provide support outside systems. I'm sharing this not as prescription, but as transparency about how one person is responding to the conditions I've described. Your situation differs, your response should reflect your circumstances, but knowing how someone else is thinking might inform your own thinking. The core message I want you to take from everything I've shared is this: your life isn't getting better because the system isn't designed to make your life better. The system is designed to concentrate resources among those positioned to capture them, while extracting resources from those not positioned to resist extraction. This isn't defeatism, it's accurate diagnosis that enables appropriate response. Understanding that the system doesn't serve you allows you to stop expecting it to serve you. The expectation that things should work out because you're doing everything right creates suffering when things don't work out despite your efforts. Releasing that expectation creates space for strategic engagement with a system you understand accurately rather than one you imagine should exist. The system that exists rewards those who understand its actual function and position accordingly. The system punishes those who assume it functions as advertised and position based on assumptions that don't match reality. Positioning means building assets they can't freeze, skills they can't take, health they can't diminish through denial of care, relationships they can't intermediate. The money frozen in the accounts you can't access represents dependence on institutional cooperation that you now know isn't guaranteed. Reducing that dependence where possible provides freedom that mere account balance cannot. Write in the comments what concerns you most about access to your own money. Have you experienced restrictions, delays, conditions that seemed fine revealing limitations you didn't anticipate? Sometimes articulating concerns helps clarify appropriate response. Share this with someone who feels stuck and doesn't understand why. The explanation that it's not their failure but system function might provide relief that enables clearer thinking. The understanding that life isn't getting better because of forces beyond individual control allows energy to redirect toward responses that actually help. They froze money because they can, because the terms allow it, because their interests sometimes diverge from yours. Your life isn't getting better because resources flow elsewhere while extraction continues from you. Understanding this changes nothing about the system. Understanding this changes everything about how you engage with the system. Engage with eyes open. Protect what you can protect. Build what they can't take. The system serves those who understand it. Now you understand it better. Use that understanding. Your stability depends on it.